One of the world's largest investors, Apollo Global Management, has just purchased a 50% stake in Australian non-bank lender MaxCap. The deal has been described as a game changer for the Australian real estate credit market, with the lender predicted to now compete head-on with the big four banks. So how would the credit markets change as a result of this transaction? To walk us through the question is MaxCap co-founder Brae Sokolski. Thanks for joining us on the Urban Developer, Brae.
Absolute pleasure, Adam. Thanks for having me.
Firstly, congratulations. There's been plenty reported on the actual tie-up between MaxCap and Apollo. We're interested to understand what it all means now for the industry. How is the business today different as a result of the tie-up?
I think what it means to the industry is it's the ultimate endorsement of the opportunity Australian real estate credit presents globally. Australian real estate credit has traditionally been the dominion of the four major banks, to the extent really they were operating in an oligopolistic environment, and the barriers to entry were very high for any competitors to come in by virtue of how cheap the bank's capital was, and also just how limited I think the thinking was in the real estate sector. They were comfortable with having that homogenous bank funding and weren't really thinking laterally, and it made it really a region that wasn't of great interest to institutional players with regards to credit. What happened with the dislocation of the banking sector several years ago, and APRA, I guess, leaving their mark with regards to banks' ability to lend to commercial real estate, is it created this significant gap that appealed to global institutions, because all of a sudden there was an opportunity to penetrate into the Australian market and a real demand that the banking sector couldn't meet. So that was the beginning. But what this transaction represents is actually the end of the beginning, if you like. Because I think now the tectonic shift from banks to non-banks really has manifested itself in a genuine push to compete against the banks, to no longer just be comfortable with, I guess, swallowing up that share that the banks can't provide for themselves, and saying, well, the entire $300 billion commercial real estate debt sector is now up for grabs. And that's what this transaction is all about. And that's why it is a game changer. Genuinely is about us saying, well, we're not just satisfied with market share in the non-bank space. We want to be there competing head to head with the four majors.
So what sort of firepower does the Apollo partnership provide MaxCap, and what is the roadmap for deploying this out?
Well, they're a $465 billion funds management behemoth. So capital is no longer a question in terms of the availability to satiate demand in this country. Apollo, don't have a lot of presence in Australia, or for that matter, the Asia Pacific region, and they've identified that as a real weakness in their funds management infrastructure. So for them, the MaxCap business represents the ideal vehicle for them to deploy capital into real estate in this country and beyond that in this region. So, we've obviously got a very, very strong front line and incomparable levels of deal flow and volume. And that is what really appealed to Apollo. So, they're very keen to deploy at scale and rapidly using the MaxCap vehicle.
Yeah. And so, Brae, from your perspective as MaxCap, this presumably means a cheaper cost of capital on the way in, which means more competitiveness on the way out. Is that right?
Yeah, I think it's two things. I think we're obviously going to be able to access some, relatively cheap capital, particularly from their insurance affiliates. And insurance money typically is quite cheap because it's very conservative, and they have a sort of long-term investment horizon, insurance businesses. So there's definitely that. There's some capital that we're going to be able to match to compete, in investment grade loans, core and core plus assets that we haven't previously been competing against the banks in that sector. But it's also, flexible capital, highly commercial capital. It's capital that we can deploy across the capital stack, across asset classes, across geographies. So it's really complementing what we already have, which is in itself is formidable. And certainly it's not about cannibalizing our existing capital sources. It's working hand in hand with our existing capital sources and our key institutional clients that have really been responsible for elevating MaxCap to where we are today. And the last thing we want to do is disenfranchise those key clients. Those key clients are every bit as important to us today as they were yesterday. But the Apollo Capital acts as an enhancement and buttresses, the significant capital we already have, and really ensures that we have that full arsenal at our disposal to compete in real estate debt and also in investment.
So let's talk about that then. So what new sectors, what new geographies will MaxCap pursue, and how aggressively in some of those areas? Can you just talk us through your business plan now with Apollo behind you?
Yeah, we're still going to focus very much on Australia and New Zealand. That's our domain. And, there is so much opportunity in our own backyard that will remain our sole focus. But within that, geographically, we've got offices now in all major capital cities, but really just exerting our influence more across Australia. We've traditionally been a Melbourne-centric business, and that's where our roots are. So, we're very keen to continue to grow our book, particularly in Sydney, where in the last 6 months, the trajectory of the business has been very steep in terms of growth. To continue to impose ourselves in the Sydney market. And then we see the other major capital cities all very, very attractive. Regional centres, very keen to support major development across regional Australia. Asset classes, we're not a policy-driven business. We don't have to be like a bank in terms of ticking boxes and, having very clear preferences. We treat every single opportunity on its merit. So, even asset classes that have been, particularly impacted by COVID, such as the office sector and hotels, we see real opportunity there. So very open-minded about supporting those, continuing to support those asset classes, and obviously staying very strong in residential, where we've cut our teeth and really forged our reputation as a market leader across that sector. But being more active, in build to rent, for example, where we haven't traditionally participated as strongly, and really ensuring that every demand from our borrower clients is met across that life cycle of real estate development. And furthermore, with regards to our joint venture and partnerships with developers. This also brings to bear significant institutional scale capital that we are able to now deploy to enhance our offering and further support those developers who are looking for capital partners.
Now, you tapped Grant Samuel to run the global search for a partner. You obviously spoke to lots and got a lot of feedback around Australia and your business. What was your read on Australia's real estate sector? How was it perceived globally? And how do you think this has changed over the last, say, 5 years?
Australia's gone from being sort of a backwater and very much bottom of mind for global institutional investors. And over the last 10 years, I think there's been a dramatic shift in mentality, and Melbourne and Sydney are genuinely now considered global gateway cities. And for that reason, not just the credit markets, but obviously the real estate itself is the cynosure of a lot of global eyes. The fact that there's appetite to invest in assets always translate to an appetite to invest in credit that sits behind those assets. So that's what we're seeing. I think you can't have one without the other. And I think Australia's come a long way in that regard particularly in the last 5 years, in terms of, being more of a target for those global institutions. And they see a lot of value in Australian real estate, and they genuinely buy into the fundamentals of our market.
Now, the non-bank sector, obviously your deal represents this, but it seems to be maturing at a really rapid pace. Other deals happening elsewhere as well. What do you think is driving this maturation of it? And what broader changes do you think are taking place right now?
Well, I think I'll come back to that point around the dislocation of that credit market, and it forced the real estate sector to look beyond the major banks. And it really was a blessing in disguise. At the time, there was a lot of pain and suffering for developers because credit did dry up for a period. But I always maintained that, the thesis, in-house thesis was this would be for the betterment of the market and the betterment of real estate players longer term. And we're really starting to see that come to fruition now. So what it did is it created an opportunity for institutional lenders and non-bank lenders to participate, not just in non-credit worthy transactions or transactions the banks didn't want to do, because that's always what the domain of non-bank lenders was in this country. If you can't get a loan from a bank, well, you go to an alternative, more expensive lender. And essentially, we were accommodating or trying to accommodate needs for developers that weren't necessarily credit worthy or real estate players that weren't. And that's why the sector sort of traditionally was somewhat tainted by that brush. But the banks, are in a position now where it's not about whether they want to lend to a client, it's whether they can lend to a client. And that's a fundamental difference. And a lot of instances they want to, but they can't. So that created this opportunity for the institutions to fill that void. And that vacuum was, is rapidly being filled, but the vacuum continues to grow. So there is still a lot of opportunity just in that set where the banks are, having difficulty meeting requirements by virtue of the APRA regulations and capital ratios. But I think the pivotal point here, and why this is a genuine watershed moment, is this is looking beyond the gap and saying, well, yeah, that is a monumentally large opportunity, but let's just look at competing with the banks on what they can and want to do, not just what they want and can't do. So I do believe that we're going to see, obviously we're not going to be the only ones trying to, actively compete. But, like we have always been able to do traditionally, we've led the charge. We did that when, in filling the gap that was created by dislocation, and now we're leading the charge on a more broader participation strategy.
Yeah. Now, for some of the smaller players out there, sort of, mortgage managers and other non-bank lenders, there's so much liquidity out there at the moment, so many people throwing money at developers and opportunities. Do you look at that and see some unhealthy risk? And I guess, where are those risk factors that we need to be considering?
Yeah. We always have an eye on the broader market industry, not just from a competition standpoint, but yes, in terms of identifying threats. And a threat to the legitimacy of the non-bank sector, obviously, is the entering to the fray of lenders that have loose credit standards, because there's very little regulation, as we're all aware, in the sector. We're not seeing that significantly, but we are seeing some examples of loose credit, which could potentially be damaging for the broader sector. Fortunately, that is more the dominion of the smaller lenders, because the large institutions put their money behind proven, credible investment managers that have the requisite resources and infrastructure to assess the risk of transactions effectively. But we are seeing some lending. If you're asking me particularly around the conditions and terms that concern me, the lending to speculative developments with no pre-commitments or no pre-sales, that's fine, if it's by exception. But when it becomes more generalized and and we see a proliferation of that type of lending. That concerns me because there is no exit, at financial close of the loan. And a lot of and some of these developments, are questionable in terms of their ability to sell during the course of construction, which is going to leave the lender exposed on completion. So, yeah, it's an area of concern, and we've certainly identified that. But I think the critical mass of capital genuinely resides with lenders who are appropriately equipped to assess risk.
Yeah. And just finally, we've heard a few people out there talking about a secondaries market being the holy grail for non-bank lending in Australia. Obviously, it's something that occurs over in the United States. Just for those that aren't aware of it, what is it, and how likely do you think it is to occur?
So when you say secondaries market, are you talking about residual stock? When you say
talking about a group like yours selling down a position to another lender.
Yeah, during the course of a facility.
That's right.
Obviously, that's something that is commonplace. You're right, in the Northern Hemisphere. We've always prided ourselves on the fact if you're borrowing money from MaxCap, you're borrowing money from MaxCap for the life of that loan. Mm-hmm. We're not about selling our positions midstream. We're not about making a turn on a loan and then redeploying that capital. So that's not our game. We're not seeing that particularly prevalent in here. In Australia, there are examples of it. But it's an important philosophical point for us that the borrower is lending money from us, and that's the way it should always remain. Now, we have often the right in our facility agreements to sell down, but that's really just a break glass in case of emergency type condition. And it's certainly not something that we've done in any of the 450 loans that we've transacted on.
And just finally, obviously, you've got a New York-based partner back in an Australian business. I mean, what are some of the things that you're learning out of the United States and applying here into the Australian market?
Yeah, I can't say at this stage we've had that opportunity. Like, unfortunately, with COVID, we haven't been able to travel to New York and to the head office of Apollo or to any of their regional offices. And the same applies to them. They haven't actually stepped foot in our Melbourne office. We haven't had the opportunity to meet face to face with, the two key Apollo guys that will become board members of our business. So I think once, the borders open up, hopefully in 2022, we're going to have that opportunity to spend time in New York and really immerse ourselves in the broader Apollo business. And I think we're going to extract some fantastic learnings from their organization and apply them to Australia and bring that best practice in, the US credit markets down under. I think we are doing a damn good job here locally, but there's always ways to improve. And Apollo are such an incredible organization and have such a phenomenal track record in credit in general, especially in the alternative space. That would be very remiss of us to not be open-minded and try and apply their best practice into our organization and into the broader Australian finance industry.
Well, Brae, congratulations again on the deal. Good luck for the future. We'll obviously watch it pretty closely.
Thank you so much for your time, Adam.
Thanks, Brae.